Florida is beautiful and everybody loves it. But behind the sunshine and palm trees, a problem is growing that most homeowners never saw coming. Beneath the postcard beaches, the market has quietly slipped into a correction, and the numbers are far more serious than anyone expected. Prices in several boomtowns are down 7 to 12% from their highs, inventory has more than doubled, and sellers are slashing $20,000 to $40,000 off their asking prices just to get serious buyers through the door. At the same time, insurance premiums and taxes are climbing so fast that even families earning six figures are struggling to keep up. This isn't a crash that makes headlines, it's something worse. A quiet erosion of equity happening city by city, street by street. Tonight, we bring you the 10 Florida cities where the pressure is building the fastest. Starting with number 10, Cape Coral. Picture this: endless canals lined with for sale signs that have been bleaching in the Florida sun for months, while boats sit motionless at empty docks. Cape Coral was supposed to be the waterfront dream. Affordable paradise with your own dock and easy Gulf access. Now, a lot of families are quietly realizing their dream home peaked in value 2 years ago. Here's the brutal math behind those vacant properties. Typical home values in Cape Coral are down around 8 to 11% from their pandemic peak. A house that could have sold in the low 400s at the top of the market is now trading closer to the mid 300s and 60s. That's $40,000 to $50,000 in lost paper equity, gone, while the mortgage balance hasn't moved. Listings have piled up, days on market have stretched from weeks to months, and price-reduced banners are becoming the default instead of the exception. For a middle-class family earning about $80,000 to $90,000 a year, that shift is brutal. You bought near the top thinking waterfront would hold value forever. Your payment is still around $2,500 to $3,000 monthly once you add taxes and utilities. But the house you stretch to buy is worth less than what you owe, and you're staring down higher insurance bills every renewal. Hurricane Ian's ghost still haunts every buyer conversation. You can't refinance because you're underwater. You can't cash out for home improvements. And selling would mean locking in a loss. So the waterfront lifestyle you thought would be your safety net is starting to feel more like an anchor dragging you down. Number 9, Punta Gorda. Picture the historic downtown waterfront of Punta Gorda. Charlotte Harbor stretching to the horizon, sailboats at anchor, restaurants along the seawall promising peaceful retirement paradise. This Southwest Florida gem was supposed to be the affordable alternative to Naples and Fort Myers, where retirees and families could enjoy the Gulf lifestyle without the premium prices. Now those waterfront dreams are colliding with market reality. The story here mirrors classic boom-bust timing. Prices peaked at $385,000 in late 2022 when remote workers and early retirees flooded in, chasing Charlotte County's lower prices and small-town charm near the Gulf. Then the correction arrived with surprising speed. Within 2 years, median prices slipped to around $345,000 to $350,000. A 9 to 11% correction that wiped out $35,000 to $40,000 in equity for families who bought at the peak. This is the sharpest sustained decline this market has seen since the 2008 crash, and inventory keeps building. But the historical context gets even more concerning when you examine the supply surge. Active listings more than doubled from roughly 1,100 homes to over 2,400, creating intense competition among sellers desperate to move properties. Homes that used to sell in 4 to 6 weeks are now sitting 90 to 110 days on average, and significantly longer if priced above market. Motivated sellers are cutting asking prices by $25,000 to $40,000 from initial listings, just to generate serious interest. For families and retirees who relocated here seeking affordable waterfront living, the affordability equation has turned upside down. A teacher married to someone in healthcare, earning a combined $95,000, bought their $380,000 home with minimal down payment. Now they're underwater by $30,000 to $35,000 after closing costs. Watching neighbors list at lower prices while their own insurance bills have nearly doubled to $5,800 annually in a hurricane-vulnerable zone. The monthly financial squeeze never eases. $2,650 mortgage, $485 insurance, $320 property taxes equals $3,455 in housing costs that compound monthly, while the home's value continues drifting lower with no floor in sight. The situation gets even worse when you examine the cost pressures creating this affordability crisis.
Number 8, Northport. Imagine buying your retirement dream home in Northport.
attracted by the promise of affordable Florida living just minutes from Gulf beaches, only to watch it become one of the fastest cooling markets in the state. Peaceful suburban streets now display a landscape of extended listings and mounting price cuts. Here's what makes Northport's correction particularly brutal compared to neighboring markets. While nearby Sarasota shows relative stability with prices down just 3 to 4%, Northport has dropped roughly 10 to 12% from its peak. Homes that were selling for $390,000 to $400,000 are now trading around $345,000 to $350,000. That's a $40,000 to $50,000 equity hit in just 18 months, significantly sharper than Port Charlotte's 7 to 8% decline and Venice's 5 to 6% dip. But wait, the crisis deepens when you compare the cost drivers that are squeezing homeowners beyond just price corrections. Property insurance in Northport now averages $6,500 to $7,500 annually. That's 35 to 40% higher than Port Charlotte and nearly triple the national average. HOA fees jumped 30 to 35% as underfunded associations scramble to cover infrastructure that developers promised but never completed. Property taxes increased 18 to 22%, even as home values decline, as the city struggles with rapid growth expenses. The comparative numbers tell a devastating story for the 2,100 families currently trying to sell. Your home sits on the market 120 to 140 days on average, a full month longer than Sarasota's 85 to 95 days. You've already cut your asking price $35,000, watching multiple showings result in 0 offers. Meanwhile, your monthly costs, $2,550 mortgage, $580 insurance, $265 HOA, $395 property taxes, drain $3,790 from your budget, while your home loses another $2,000 to $3,000 in value every quarter. For a nurse and a construction worker earning $92,000 combined, the financial trap tightens monthly. You moved here thinking affordable Florida living meant building equity and security. Instead, you're hemorrhaging money with no good options. Stay and bleed slowly, or sell at a significant loss and start over.
Number 7. Deltona. Behind Orlando's theme park glow, Deltona's sprawling subdivisions are experiencing one of Central Florida's sharpest corrections. And the trend lines suggest the pressure isn't easing anytime soon. What started as minor price softness has evolved into a 9 to 11% slide from peak that's forcing uncomfortable conversations about affordability and market timing. Picture watching your home value drop about $2,500 to $3,000 every quarter for the past 2 years. That's the reality for Deltona homeowners as median prices slipped from around $365,000 to roughly $330,000, about $35,000 in lost equity. But here's where the trend analysis becomes concerning. The pace isn't stabilizing as quickly as other Orlando area markets. While some suburbs are finding a floor, Deltona's inventory keeps building, and days on market keep extending. The predictive elements paint a challenging picture. Active inventory has more than doubled from last year, now sitting around 2,400 properties, compared to about 1,000 12 months ago. That's a supply surge that creates overwhelming competition among sellers. Properties that used to sell in 30 to 45 days are now taking 90 to 120 days, and that's if you're priced aggressively. The months of supply metric hit 8 to 10 months in some price ranges, well into correction territory. For families earning Orlando's median income of $78,000, the forward outlook creates genuine financial anxiety. You bought at $360,000 thinking Disney employment stability and Orlando growth protected values. Now you're watching your home trade around $325,000 to $335,000, putting you underwater or barely above water, depending on your down payment. Your mortgage payment is $2,420 monthly, but comparable rentals have dropped to $1,750 to $1,850 as investor landlords compete aggressively for tenants. The visible warning signs multiply. Neighborhoods routinely show 4 to 5 for sale signs per street. Price reductions appear within 3 to 4 weeks of listing instead of after months. Open houses that used to draw 10 to 15 groups
now attract 2 to 3 at best. Desperate sellers are offering $8,000 to $12,000 in closing cost credits, home warranties, and appliance upgrades. Yet properties still sit for months without serious offers. What started as a temporary cool down after pandemic gains now looks like a sustained correction that's testing the finances of families who bought thinking Orlando's growth story was bulletproof. And if Deltona's inventory buildup feels concerning, just wait until we examine Fort Myers' post-hurricane nightmare.
Number 6. Fort Myers. Fort Myers represents one of Florida's sharpest price corrections, a 10 to 14% decline that's the most significant drop this market has seen since the 2008 crash. Behind the beach postcards and sunset Instagram photos, thousands of families are trapped in financial stress with no clear escape route. Here's the brutal math that's crushing household budgets. Median prices dropped from roughly $440,000 to around $380,000 to $385,000. But the real devastation isn't just the price correction. Hurricane Ian's psychological toll means every tropical storm triggers insurance anxiety. Homeowners' insurance costs have doubled or even tripled. Many families now pay $7,500 to $9,500 annually, up from $2,500 to $3,500 just 3 years ago. Special assessments for hurricane repairs hit condo owners with surprise bills ranging from $12,000 to $40,000. Property taxes jumped 20 to 25% as the city rebuilds infrastructure while trying to maintain services. For a typical family with a $425,000 purchase who bought in early 2023, the monthly costs tell the story. $2,850 mortgage, $715 insurance, up from $240. $450 property taxes, $185 HOA equals $4,200 in housing costs. On a household income of around $97,000, that leaves minimal room for everything else: food, transportation, student loans, childcare, medical expenses. Emergency savings get drained. Credit cards carry balances that didn't exist before. Second jobs become necessary just to cover the insurance increases. Selling means accepting a $45,000 plus equity loss plus another $23,000 to $26,000 in transaction costs, money most families don't have. Staying means watching financial cushions evaporate while praying home values stabilize. Refinancing isn't an option at 7+% rates when barely above water or slightly underwater. The trap has steel jaws. This personal crisis has played out across Fort Myers for thousands of families who bought during the post-Ian recovery optimism. Properties sit empty longer, families delay maintenance to preserve cash, and the community fabric frays as financial stress radiates through households.
Number 5. Lakeland.
Between Tampa and Orlando, Lakeland's strategic location and major employer presence were supposed to guarantee housing market stability. Picture distribution centers for Amazon and Publix creating steady jobs, new residents chasing Central Florida affordability, and a downtown revival suggesting decades of growth potential. Now picture for sale signs on every other block as one of the region's more significant price corrections unfolds. Here's the brutal math behind Lakeland's slide. After surging over 50% during the pandemic years, prices have given back a meaningful portion of those gains. Median home values that peaked around $350,000 to $360,000 have corrected to approximately $315,000 to $325,000, roughly a 7 to 10% decline representing $30,000 to $40,000 in lost equity for recent buyers. This is the most significant sustained correction this market has experienced since the 2008 crisis. But the statistical reality shows pressure across all price segments. Starter homes under $250,000, supposedly the resilient foundation of any market, are down about 8 to 11% as first-time buyers struggle with affordability despite price corrections. Mid-range properties from $250,000 to $400,000 have dropped 6 to 9% as move-up buyers discover they can't sell their current homes without taking losses. Even higher-end homes above $450,000 are down 5 to 7% as buyers migrate toward more established Tampa and Orlando suburbs. The inventory expansion tells a concerning story beyond just prices. Active listings have more than doubled year over year, jumping from around 900 to 1,000 to approximately 2,200 to 2,400 properties. That supply surge creates intense competition among sellers. Homes that previously sold in 35 to 50 days are now averaging 75 to 95 days on market, and that timeline stretches to 120 plus days if you're not priced competitively. The months of supply metric has pushed into the 6 to 8 month range in many segments, signaling a definitive buyer's market where sellers have limited pricing power. For a middle-class family earning Lakeland's median income around $62,000 to $65,000, these corrections actually make affordability worse, not better. You bought a $355,000 home with 5% down in early 2023 thinking you were securing your family's future. Today it's worth perhaps $325,000 to $330,000, putting you underwater by $10,000 to $20,000 after accounting for selling costs. You're paying $2,380 monthly, mortgage, insurance, taxes, HOA, to own a home that hasn't stopped declining in value yet. The math creates genuine financial anxiety even without catastrophic losses. Renting a comparable home costs $1,700 to $1,850, potentially $500 plus less monthly than ownership. You're effectively paying a premium to lose equity slowly, but walking away destroys credit and potentially triggers deficiency judgments. Refinancing isn't feasible when you're underwater and rates are 7% plus. You're trapped in a slow financial bleed with no attractive options. Meanwhile, your family planning suffers collateral damage.
Number 4. Ocala.
Once upon a time, Ocala promised the perfect Florida retirement dream: affordable living among rolling horse farms, mild winters without serious hurricane threats, and thriving 55-plus communities building equity for golden years. That narrative is cracking under the weight of financial reality, and it's hitting retirees on fixed incomes especially hard. The historical trajectory reads like a cautionary tale about timing. In 2021, Ocala was genuinely Florida's value gem. Median prices around $245,000 to $255,000 attracted retirees fleeing expensive northeastern states. They sold costly homes up north, moved south with substantial cash, and bought with large down payments or outright. By late 2022/early 2023, that median had surged past $375,000 to $385,000, a stunning 50 to 55% increase in under 2 years that felt like perfect timing for early arrivals. Then market dynamics shifted with concerning speed. Within 18 months, prices corrected to approximately $345,000 to $355,000, about an 8 to 10% pullback from peak that eliminated 2 years of appreciation. For retirees who bought at the top thinking they'd locked in affordable Florida living forever, this correction represents meaningful paper losses on what was supposed to be their final home purchase. But here's where the cost driver analysis becomes truly devastating for retirees on fixed budgets. It's not primarily the price correction crushing household finances, it's the explosion in carrying costs. Property insurance for retirees who bought in Marion County has jumped from roughly $1,800 to $2,200 annually to $4,800 to $6,200. That's $250 to $350 monthly that didn't exist in their retirement budget 3 years ago. HOA fees in popular 55-plus communities have surged 35 to 45% as aging infrastructure demands expensive repairs, while property values stagnate or decline. Property taxes increased 25 to 32% despite price corrections, as the county struggles with growth-related expenses. For a retired couple living on $58,000 annually from Social Security, a modest pension, and some retirement account withdrawals, these cost explosions devastate carefully planned retirement budgets. You bought your $380,000 retirement villa with $165,000 down, your life savings from selling your Pennsylvania home after 40 years. You calculated that a $1,750 mortgage payment at age 67 was safely manageable with your fixed income. Now add the new reality, $1,750 mortgage plus $440 insurance, up from $165, plus $315 HOA, up from $215, plus $265 property taxes, plus $95 for flood insurance you didn't need before. Your total housing cost hit $2,865 monthly against $4,833 take-home income. That's 59.2% of your budget consumed by shelter alone. You're hemorrhaging retirement savings at $600 to $800 monthly to cover the gap. The travel plans you retired to finally enjoy, canceled. The financial help you promised grandchildren for college, can't afford it anymore. Medical co-pays and prescriptions create anxiety because there's no cushion. And your home is worth about $355,000 against a $225,000 remaining mortgage. You could technically sell without catastrophic loss, but where would you go that's more affordable while staying in Florida? The retirement dream has morphed into a monthly budget nightmare with no good escape for thousands of Ocala retirees. Number 3, Clearwater. While Clearwater Beach's white sand coastline still draws tourists to Pier 60's sunset celebrations, the year-round residents who serve those tourists are experiencing a devastating financial squeeze. Picture the contrast. Beautiful Gulf sunsets and high-rise beachfront condos on one side, service workers driving 45 minutes inland because they can't afford housing anywhere near the beach they work at on the other. Here's the comparative reality exposing Clearwater's affordability crisis. Median home prices peaked around $425,000 to $440,000 and have corrected to approximately $375,000 to $390,000, roughly a 10 to 12% decline representing $50,000 to $65,000 in vanished equity for recent buyers. Meanwhile, the homes that cater to wealthy snowbirds and retirees show smaller 5 to 7% declines, while working-class neighborhoods inland from the beach are getting hit hardest with 11 to 13% drops. The price per square foot comparison reveals the exodus from affordability zones. Areas like Clearwater's eastern neighborhoods fell from approximately $215 to $225 per square foot to around $185 to $195 per square foot, a $25 to $30 decline, signaling local buyers can't compete anymore. Beachfront properties maintain premium pricing despite corrections. The message is clear: tourist economy benefits property owners, not the workers serving tourists. But the comparison becomes even more brutal when you examine carrying cost crushing local families. Property insurance in coastal Clearwater now averages $8,500 to $10,500 annually. That's double or triple what it was 3 years ago, and among the highest rates in Florida. Flood insurance requirements add another $1,200 to $2,400 annually. Property taxes jumped 22 to 28% even as values correct. HOA fees in beach area condos surged 35 to 45% as aging buildings face expensive repairs and insurance cost pass-throughs. For a restaurant manager married to a hotel worker earning a combined $87,000 serving Clearwater's tourism industry, these numbers create impossible math. You bought your $430,000 home thinking beach proximity justified the stretch. Your home is now worth $380,000. You lost $50,000 in equity while your monthly costs exploded. Your mortgage payment stays at $2,850, but insurance jumped from $320 to $875 monthly. Property taxes increased to $485 monthly. Add $145 for required flood insurance. Your total housing cost hit $4,355 monthly against $5,460. Take-home pay, that's 79.7% of income just for shelter. You work where tourists vacation, but you can't afford to live there. Your commute from affordable housing is 35 to 45 minutes each way. You're paying nearly 80% of take-home income to own a depreciating asset while serving people on vacation. The irony stings daily. The psychological toll compounds. You serve Clearwater Beach's tourism economy but can't afford the community you help sustain. Number 2, Kissimmee. In Disney's shadow, Kissimmee's housing market is experiencing a correction that local real estate professionals privately describe as one of Central Florida's most challenging environments. And the forward-looking indicators suggest stabilization remains months away at minimum. Picture this trend pattern. Steady price softening that began in late 2022, accelerated through 2023 and into 2024. Prices that peaked around $415,000 to $428,000 have declined to approximately $355,000 to $370,000, roughly an 11 to 13% correction representing $45,000 to $60,000 in lost equity. This represents the sharpest sustained correction in the Orlando area and one of the steepest drops in Florida's major metro markets. But here's where trend analysis becomes genuinely concerning. The stabilization signals that typically appear after corrections aren't materializing yet. Foreclosure filings have increased significantly year over year, up more than 180 to 200% according to county records, though still well below 2008 to 2011 crisis levels. Short sale activity has doubled. Price-reduced listings represent 55 to 65% of active inventory in many neighborhoods, meaning more than half of all homes for sale have already been cut at least once, yet buyers remain cautious. The predictive indicators paint an extended correction scenario. Inventory levels have reached 8 to 10 months of supply in several price segments, well into buyer's market territory where sellers lack pricing power. New construction permits have dropped dramatically, down 65 to 75% year over year, as builders avoid a market with sustained pressure. Days on market average 95 to 115 days, with improperly priced homes sitting 150 plus days. For families who relocated to Kissimmee believing Disney employment anchored housing stability, these forward trends threaten carefully planned budgets. A hotel operations manager earning $72,000 and a restaurant supervisor making $48,000, combined $120,000 serving Orlando's tourism industry, bought their $420,000 home in early 2023. Today, it's worth approximately $365,000. They're underwater by $35,000 to $45,000, depending on their initial down payment. Their mortgage sits at $2,850 monthly, but comparable rental properties have dropped to $1,950 to $2,100 as investor landlords compete desperately for tenants in a softening market. They're effectively paying $750 to $900 monthly premium for the privilege of owning a depreciating asset while building almost no equity. The forward timeline offers limited optimism. Best-case modeling suggests 4 to 6 years to return to their purchase price, assuming normal 3 to 4% annual appreciation after stabilization. Worst-case scenarios extending correction through 2025 could mean 8 to 10 years to recovery. They're in their mid-30s with 2 elementary-age children. By the time they recover their entry equity, they'll be approaching 50, their kids preparing for college, and their retirement savings years behind schedule. Local real estate agents confirm the challenging outlook. One veteran broker who weathered the 2008 crash shared candidly, "This feels different. In 2008, we saw denial, then panic, then capitulation. Now we're seeing immediate market awareness. Everyone knows the correction is happening, but buyers are still waiting for better entry points, and sellers are still hoping for recovery that isn't coming yet. We're stuck in this limbo that could extend well into 2026. Number 1. Miami-Dade inland areas. Welcome to Miami-Dade's inland neighborhoods. Kendall, Westchester, Sweetwater, Hialeah, Doral's outskirts, where the American dream confronts brutal financial reality behind Spanish-language Se Vende signs, and the constant anxiety of monthly bills that never stop climbing. This represents Florida's ultimate affordability crisis. After years of explosive pandemic-era price surges that pushed median inland prices past $475,000 to $490,000, these neighborhoods have corrected 5 to 8% to approximately $440,000 to $465,000. That might sound modest, just $30,000 to $45,000 in paper losses. But here's what makes Miami-Dade's situation uniquely devastating. When you combine that price correction with insurance bills that doubled or tripled, HOA fees that jumped 40 to 60%, special assessments hitting condo owners, and mortgage rates near 7%, the real financial damage to middle-class families far exceeds what any price chart shows. Consider a typical scenario. A family earning $122,000 combined income, representing 2 public service professionals, bought a home in Kendall for $480,000 in March 2023, stretching every dollar to achieve homeownership in Miami's impossible market. Today, that home is worth approximately $445,000 to $450,000. They've lost $30,000 to $35,000 in equity on paper. Here's the impossible math destroying household finances. $3,180 mortgage plus $795 insurance, nearly tripled from $285 3 years ago, plus $425 property taxes plus $95 HOA equals $4,495 monthly housing costs against $7,650 take-home pay. That's 58.8% of income consumed by shelter alone, before groceries, transportation, children's school needs, student loan payments, or medical expenses. Families in this situation report maxing credit cards covering monthly shortfalls. Emergency funds drain completely. Second and third jobs become necessary, working 100+ combined hours weekly and still falling behind $600 to $700 monthly. Children's needs go unmet. Family vacations disappear, date nights stop, basic school supplies become luxuries. The emotional devastation multiplies the financial pressure. Parents report feeling unable to provide basic supplies other families take for granted. Public service professionals wonder if abandoning their pensions for private sector money would save their families. Financial stress dominates household conversations. Every grocery trip becomes negotiation. Every unexpected expense triggers panic. Every reminder that the home is worth less than purchase price feels like failure. The community-wide impact radiates through Miami-Dade's working-class inland neighborhoods. Teachers leaving schools they've served for decades because living nearby is financially impossible. They're commuting 75 to 90 minutes each way from Homestead or even Broward County. Firefighters and police accepting that affordable housing near their stations is a fantasy. Local businesses watching revenue decline as customers' discretionary spending evaporates. The demographic transformation is visible. Young professional families who drive community involvement being replaced by investor-owned rentals with transient tenants. But here's where Miami-Dade's situation becomes uniquely catastrophic compared to other correcting Florida markets. This area faces compounding crisis factors that other metros avoid. Sea level rise and climate change awareness drive hidden exodus from coastal properties. Except those fleeing expensive coastal areas move to Tampa, Orlando, or out of state entirely, not to inland Miami. Insurance companies have dropped entire zip codes or raised premiums 200 to 300%, forcing homeowners into Citizens property insurance at multiples of previous costs. International buyers who once provided market stability have largely disappeared, discouraged by currency exchange rates and remote work trends ending their U.S. relocation plans. The condo crisis adds special assessment bombs, some Kendall condo owners facing $35,000 to $50,000 surprise bills for required building repairs. Families in this situation face impossible choices with no good options. Selling means accepting a $30,000 to $35,000 equity loss plus $25,000 to $28,000 transaction costs. Total $55,000 to $63,000 they don't have. Foreclosure destroys credit for 7 years and potentially triggers deficiency judgments depending on specific loan terms and Florida statute application. Staying means bleeding $600